The IRS just released the inflation-adjusted tax bracket for 2026, and these changes are going to affect millions of Americans, including 38 million small business owners. This is not just a tax headline that comes and goes. If you own a business, these changes are going to show up as real dollars, either going into your bank account or out of it. And here's what this actually means. Most of your income will be taxed at lower rates because the brackets are widening. For example, if you're married filing jointly, the 24% tax bracket now extends up to $211,400. That means you can earn significantly more before any of your income even touches the next 32% bracket. For business owners, this opens the door to saving thousands of dollars just by being intentional about when and how you recognize your income. For investors, this means you can report less taxable income on the same investment returns. And if you are strategic, you can use tools like the HSAs, Roth IRAs, and retirement accounts to shelter even more of that income inside these lower brackets. With a licensed CPA and tax planner at HavenStone, I have already gone through all of these revenue procedures tied to these 2026 tax law changes for you. My entire job is taking complex tax rules and turning them into clear, up-to-date strategies that help business owners keep more of what they earn legally. So let's jump right in. The number one biggest misunderstanding I see is this. Business owners think their entire income gets taxed at the bracket they fall into. But that's not how our system works. We have a progressive system, which means only the top slice of your income is taxed at your highest bracket. For example, if you're married and file jointly with your spouse, I want you to picture a wedding cake with different layers. The bottom layer, your first $24,800 of taxable income if you're married filing jointly, gets taxed at just 10%. The next layers, from $2,400 up to $108,000, gets taxed at the 12%. Only the portion that sits above $108,000, the next layer out, get taxed at 22%. And if you make even more than that, only those very top layers get hit with the highest tax rate. Each layer of income has its own tax rate. You're not paying the top rate on the whole cake. You're only paying that higher rate on the top tier of income that actually falls in that bracket. This matters because business owners often plan based on the wrong number. They hear 22% bracket and assume that everything they make is taxed at 22%, which is never the case. This is just one simple example to help the picture click. If you would like a copy of the 2026 tax tables for single filers and married filing jointly, comment tax table below and I will send it to you. But before you print that tax table and forget about it, there's one important catch. That bracket does not stay still. Inflation is the reason these brackets and thresholds change every single year. Inflation usually runs around 2.9 to 3.2%, which means salaries increase. Grocery bills increase, gas increases, real estate taxes increase, everything goes up. Because of that, the IRS adjusts the brackets upward too. That means it now takes slightly more taxable income to hit the same brackets in 2026. Now here is why this really matters to you as a business owner. If you're an S corporation owner, a partner in a partnership, or sole proprietor, the business itself does not usually pay federal income tax. Instead, the profit passes through to you and you pay tax at ordinary income tax rate using the progressive brackets we just walked through. C-Corps are a whole different animal with that flat 21% tax and potential double taxation when you pull the money out. For most small and mid-sized business owners, the biggest planning opportunities are inside pass-through rules, which is where we're focusing on today. But here's the thing, pass-through brackets alone do not make you wealthy. Strategy does. And that's why wealthy business owners do not stop at checking their tax bracket. They layer on advanced strategies that multiply that savings. And you can use those exact same strategies in your business starting now. You can start with timing, because timing income and deductions within these brackets can save you tens of thousands of dollars. You can also delay invoicing to push income into the next year, or you can accelerate revenue if you need to stay under a specific threshold this year. And then you can strategically stack deductions. With the Big Beautiful Bill, raise the SALT, state and local taxes deduction cap from $10,000 to $40,000. This is a big deal. You can bundle property taxes, charitable contribution, and donor advised fund contributions into powerful deductions years that really move the needle for you. You can also harvest capital gains wisely. That means realizing gains right up to your tax bracket ceilings and offsetting them with losses so that you're optimizing your taxable income instead of accidentally overpaying. But even if you master the federal bracket, You cannot forget about states and payroll taxes. Federal brackets shift with inflation, but state taxes and payroll taxes do not always move the same way or on the same schedule. This is why planning still matters so much. I've seen business owners miss out on $50,000 or more in taxes per year because they did not plan their taxable income correctly. To conclude this video, I'm going to give you a simple tax checklist to stay ahead of the new 2026 tax rules. Everything on this checklist is really about one thing: deciding which brackets your income will land in for 2026 and how much ends up in those tiger slices. First, map the new 2026 tax brackets for your filing status so you know exactly where your thresholds are. Second, decide which income you want to accelerate and which income you want to defer based on those thresholds. Third, set your compensation targets early, especially if you are an S-Corp or C-Corp owner. Fourth, choose your deduction strategy for the year. Decide whether you're going to spread deductions out or take them in single concentrated month or quarter. And fifth, pre-schedule quarterly planning meetings so you can catch every update and deadline instead of reacting at tax time. This checklist prevents surprises and keeps your tax exposure predictable. Knowing the brackets is one thing, but knowing the right entity structure to use with these brackets is what actually builds wealth over time. Because even if you get the brackets right, the wrong entity structure can make you overpaying tens of thousands in taxes every year. Most business owners are still using entity structures that worked when they were small, but those same structures start to fall apart once they cross $1 million in revenue. That is exactly what I break down in my next video, where we walk through which entities make sense at different revenue levels and how to use them effectively with the new brackets. If you're ready to dial in your structure and stop overpaying, I will see you in the next video.